Hope you made it to work on time. I know a few people have been struggling due to the weather. For those of you that don't know me, I'm Lisa Kennery, one of the directors at Pierce Accountants here, based in Blackburn. This morning we're going to cover off salary exchange schemes and really the history behind what you could exchange to what you currently can exchange, and additional benefits that you can perhaps look at in alternative ways to salary exchange. So otherwise known as salary sacrifice, the meaning of salary exchange is where an employee chooses to exchange remuneration cash for an additional benefit, which is a non-cash benefit. There are some key considerations, one of which is that it is a contractual change. So many employers forget that they do the logistics and the actual processing side of the salary exchange via payroll, but they forget to do the HR element, which is making sure that you're covering it in a letter. You've got an amendment to your main contracted employment just to state to that individual that they are exchanging part of the salary for a non-cash benefit and what that non-cash benefit is. National minimum wage. So we all know each April the national minimum wage changes each year. When you apply a salary exchange to an individual's pay, you mustn't take them below that national minimum wage regime, depending on their age. So that's something just to consider when you're processing through the payroll. So a number of advantages and disadvantages. So we'll start with the advantages in the first instance. So reduces tax for an employee, reduces the national insurance payment, they gain a non-cash benefit, and we'll go more into detail in what those could be. And the employer saves on the national insurance. Now this can be paid, just saved by the employer, or they can choose to reinvest it in various different ways. Disadvantages, it can affect those calculations. So possibly a key one for everyone that's important to notice is the mortgage borrowings. So it will be calculated on the lower salary amount after the exchange has taken place. Same with maternity for any ladies that are due to go on maternity leave. So it may be that it's a lifestyle change, which we'll cover off next. So those lifetime changes, it may be upon that significant change that the employee decides to reduce that sacrifice down or eliminate it completely. So the lifestyle changes may be divorce, could be down to marriage, pregnancy, and redundancy. So it's important just to keep those in your back of your mind for if you do know an employee is going through that lifestyle change, that you can have the conversation in time. What you can sacrifice. Unfortunately, HMRC have clamped down over recent years in terms of what you can sacrifice through payroll. It's now restricted to payments into pension schemes, employer provided pension advice, childcare vouchers, which we'll come on to in more detail, and cycle to work for bikes and equipment. So for pensions, many employers went through the auto enrolment process in a hurry. So the first priority was really to make sure that you were covering from a compliance perspective. But now it's an ideal opportunity to review and evaluate that pension setup and see if you can introduce salary exchange, which would save money for both the employer and the employee. You can use it with the government scheme of Nest as well. So majority of pension providers do offer a salary exchange. It's important that if you are going through the process to make sure you pick up with the pension provider to make sure you set up the relevant category. Otherwise, there might be common pitfalls further down the line. So to give an example of how you can use it through pension, opposed to a net deduction, for example. So with the salary exchange, an example here is the person earning £2,000 a month, currently a 20% taxpayer and on the normal personal allowance. So the tax did pay without the exchange £190.50. National insurance would be £144.36, and the net pension deduction that they've chosen to pay over is £100. Now I've done this like for like just so you can see the saving element, which brings you to a net pay for the individual of 1565.14, and the employer's national insurance on that calculation is £174.29. With the exchange in place, we have a salary again of £2,000, but in this instance they have that 20% saving on the £100, so the tax is £170.50. The national insurance would be £132.36, leaving the pension deduction being £100. So the net equivalent would be 1597.14, and the employer NIC would be £160.49. Therefore, the employee saving on this calculation would be £32. Now I've used a small amount really here to show there is a saving, but as the pension pot grows and as the deduction, the salary exchange is higher, the saving is higher. This is again only based on a 20% payer. So when you're a 40% payer, you're getting that tax relief directly at source. It is beneficial. The employer saving of £13.80. Now that can be, like I said before, reinvested. Some businesses choose to put that into back into the pension pot, for example. Some people might say, right, we'll save 50% will save and 50% will pop back into the pension pot. So it's just down to each employee what preference is for that. Childcare vouchers. So slightly different into these were restricted for new entrants. Come October 2018, so only existing employees that can utilise the benefit of your childcare vouchers. But again, I've put an example together so we can work through to see the potential saving that the employee does make. These are now for the 20% taxpayer in the example that I've used, it is £243 is the maximum childcare voucher. For a higher taxpayer of 40%, that's actually restricted to £124. You must reassess at the beginning of each tax year. So it might be that you had a 20% payer that has now gone into the 40% tax bracket, which means that then the childcare vouchers would be reduced to the £124. You do ordinarily use a third party, such as Busy Bees, to use these deductions, and the voucher isn't an actual voucher that you receive. It can be an electronic version that's paid directly between the employer and the voucher person, the employee. The scheme that has been replaced is called the tax-free childcare. It is no longer administered by employers, so you just need to redirect your staff to the government website, and they can follow the details from there and see if they're eligible to do that tax-free childcare account. It's very similar to bank account, where they pay the monetary value via that, and they get the tax saving. So not the national insurance, it's just the tax element that they save. Some staff are more beneficial for them to use the tax-free childcare scheme. Some of the childcare vouchers were beneficial. It's just dependent on the amount of childcare for the childcare provider, the cost of that. So in this instance, the childcare vouchers, so without the vouchers in place, the net pay for the employee is £1665.14. However, the childcare cost, if this was £243, the net element that's costing them is £1422.14. Whereas with the salary exchange, we have £2,000 of salary, the tax would be reduced to £141.90. The national insurance would be reduced to £115.20, giving a new net pay of £1,499.90. The employer NI would be reduced also to £140.76. So that's using a childcare voucher of £243. The employee saving in this example, so the employee save £77.76, the employer saving £33.53. So now we're restricted to what we can sacrifice. It's looking at alternatives that we can perhaps provide for staff that again is going to be beneficial for them. So a season ticket loan. So many staff may use public transport, whether it be the bus or whether it be the train. An annual pass is cheaper than paying for a pass monthly. So you can offer to buy an annual pass for that employee and then deduct it from their net pay over a 12-month equivalent. Now, it is just a saving of being able to buy the annual pass opposed to them buying it monthly, but it is still quite a decent saving on that. Gym memberships. So previously they could be deducted from the gross pay. This is no longer allowed from a HMRC perspective. The deductions do need to be from the net pay. However, again, corporate membership is a great deduction, great incentive to say how to save money. If you get that group corporate discount, it's much better than the individuals going and get the membership separately. Electric cars. So a hot topic at the moment, and one that many employers are probably considering to offer out to staff, to their own staff. Many of the benefits, including cleaner environments, no congestion charge, lower running costs, some say better driving experience. That will probably yet to be determined. Government funding and reduced noise pollution. All great incentives for the environment, which is something that we should all be considering. The benefit in kind is much lower than a normal vehicle. So it's currently for this tax year 1%, but come April 22, that will be increasing to 2%, but still a very low benefit in kind. The 0% rates also extended to the pure electric vehicles that are registered before 6th of April 20, and hybrid cars that were registered from 6th of April 20, but only with emissions 1 to 50 gram/kilogram and a mile range of 130 miles or more. Business mileage. So as we know, ordinarily it's up to 45p per mile, and you can claim for that passenger rate. This is reduced significantly for an electric vehicle. The business mileage is 4p per mile for any business miles that they need to claim back. There is no tax benefit if you provide, as an employer, charging points. There are grants for the charging points currently, up to 75% in the home. However, this is due to cease come 31st of March 22. So if individuals are considering it, and perhaps you're looking at that as an incentive to introduce to your staff, perhaps now is the right time to ensure that those electric points are installed in the homes prior to the end of March. There are still workplace grants for the charging points which remain in place. The application for that is on the government website. Tech scheme, again, another great initiative. This has potentially been brought in to help people that are doing a hybrid role, to perhaps cover costs of internet, laptops, additional laptops and iPads, especially when children were working from home during COVID. Shortage of electrical equipment in homes has been noted. The employee, slightly different in terms of the benefit in kind and the salary exchange, in that the employee only saves the national insurance element. the tax isn't a saving. So how it works, you would deduct it as an ordinary salary exchange. So from the gross, they would get the tax and national insurance saving in the initial stage. However, you would have to claim that tax back. So whether it be that you're payrolling that initiative, so they're paying the tax comes out and then back in the same instance, or whether you pop it on a P11D, at some point the tax element will be repaid for that benefit. So it is only the national insurance element that is of a benefit. Gaming consoles aren't allowed. So unfortunately you can't go out and buy the latest Switch under this scheme. But like I said, it is a great initiative for additional laptops or internet, things like that. So an example of the tech scheme. So price of the package could be £700, for example. The NI saving on that individual, currently using the current rate of 12%, would be £84. The tax saving in the initial period would be the £140. However, when you're either adding that back when you're payrolling the benefit, or if you're applying through the P11D, which will then affect the tax code later in the day, you would pay that tax back of £140. So they contrary each other off. So therefore the employee saving is the £84. Still a great benefit to have in place for staff. So how to report benefits, how to do the reporting and the tax of the benefits. There's different options. So the first is payroll and benefits. Advantage of this, making sure that it's done in real time, keeps the employees' tax codes cleaner. So historically, it's all been done through P11Ds. It was something that was introduced a couple of years ago where you could payroll the benefits. Just that tax code will stay at a normal personal allowance, and you'll see the tax being deducted in real time through the payroll and on the pay slips. To do this, however, you must register with HMRC prior to 6th of April. There are some exclusions, what you can't benefit, which I've included on here, which is accommodation, which is provided by the employer, and interest-free loans. You have to register by the 6th of April, but however, you can exclude some of your employees. So if you do have 100 employees, for example, and you only have 5 that you provide an interest-free loan to, you could still payroll those 95 employees and do a P11D for the remaining 5 employees. If you do payroll benefits, you no longer need to submit to P46 car for those cars. Notification to your employees must be provided by the 1st of June following the year that they've had the benefit. That would include the benefits that have been payrolled, the amount that's been exchanged, and any benefits that haven't been payrolled. And you'd still need to complete a P11DB form, which is where you pay your Class 1A over on. Just on the note of the P11DB form, we may see in the future that HMRC will introduce that you can collect that Class 1A through payroll, but when that will be, we're not too sure. Via a P11D, this is an alternative option. They must be submitted by the 6th of July each year, and the Class 1A via the P11DB must be paid by the 19th of July or the 22nd if you make those payments electronically. PSA, so you can still use a PSA for minor or one-off benefits. Now I've included an example on here, so it might be incentive awards for long service, or for employees doing a great job, could be small gifts or vouchers, relocation over the £8,000 free allowance. You have to apply in writing to the HMRC for a PCA agreement, and that application has to be reached before the 5th of July. and payments for this are made on the 22nd of October of each year. The 19th, if you do still make a manual payment. So I thought we would note some common pitfalls that we see perhaps when we're processing payrolls or when we do audit reviews of those payrolls. So gym still deducted from the gross, that you can no longer do. Salary exchange that's shown on the pay slips. So this is where you have an exchange in place, but you don't show the top line and what the deduction is for. I think this was quite common some years ago, but payrolls have tended to be cleansed by now. But it's something to watch out for. Make sure that if you've got any exchange in place, you note it on the pay slip so they can clearly see the top line salary and the salary that they've exchanged for the non-cash benefit. Treatments incorrectly set up. So that is the salary exchange element within the payroll function. It might be that it's just ticked to reduce the tax only. It could be to reduce the NIC only. So there's several variations on how that can be incorrectly set up. Pension setups incorrectly with the provider. One to watch out for, which I mentioned before, ensure that if you are setting up the salary exchange for your pension, that you notify your pension provider and you can set up a category that's applicable. The last thing you want, which we do see is quite common, is a deduction directly for tax relief for your payroll, but then your individuals are getting the tax relief by the pension company because they're claiming that relief on your behalf. And it's just a lack of communication with that error. Breach of national minimum wage. So again, national minimum wage increasing every April. We just need to watch out that if we do have salary exchange, if we've got any individuals that are close to that bracket, that we keep an eye to make sure that they don't drop below minimum wage. And failure to communicate with staff regarding the contractual change. So they do need a letter, which is an amendment to the main contract, saying that they're reducing the salary element and what that benefit is that they're actually exchanging, what the value of the exchange is, and what they're getting in place of that. So that's the end of any slides. But I did think we'd just open it up to the room to see if we've got any questions. There is much more detail in terms of the actual electric cars and the tech scheme as well. There are some great providers out there, third-party providers that you can go through. But have we got any questions? Lauren, have we got any in the chat box?
Yes, we do. So one that's in the chat box, is there a deadline for applying for the corporate EV charger grant?
I didn't see any deadline. I will check that, but I don't think so, no, at the moment. I think it's just the home grants for the charging points.
That's the only question for the moment.
Okay. Lauren, would you mind putting, what we'll do, we'll put my contact details in the chat box, and feel free to get in touch should you have any questions. You can get me on the main office number, which is 01254 688 100, and my email address is l.kennery, it's KENNERY @pearce.co.uk. Thanks for joining, everyone.